welcome. You're watching India Tonight with me, Ankur Mishra, and my co-host Sumita Karir. And in next 1 hour, we'll touch base with all the matters, all the important updates that matters to you. But let's get started with the story of the day. We are discussing about India's economy. And India's GDP growth has remained one of the strongest among major economies. In fact, the country's economic engine picked up more speed in the September quarter, with official data showing that real GDP grew at 8.2% in Q2 of FY26, which is stronger than the 7.8% posted in the first quarter of the current financial year. Now, the surge also beat most forecasts, even as economy faced pressure from US tariffs. Meanwhile, inflation has plunged. October CPI has come in at just 0.25%, which keeps India firmly on the disinflation path. High growth and very low inflation together create a confusing but fascinating picture. Suddenly, nominal GDP has turned into the number that many experts are watching more closely than the real GDP.
Absolutely, Ankur. In fact, strong domestic demand, rising public capex and resilient services have kept India's growth engine running. But now, many are questioning this surge. In fact, the IMF recently gave India a C grade for its national account statistics. It highlighted that there are persistent concerns around data quality. And that really raises concerns about how accurately we're measuring economic activity in the country. And hence, the big question tonight on the show that we are asking, is the story more nuanced than the headline GDP number suggests? And why is India beating every estimate? And what's driving this mysterious growth? And analysts and policy makers, they're still trying to decode all of that. And in fact, helping us decode this big story tonight on the show are two very accomplished guests. Rajni Sinha, she's the chief economist at CareEdge Group. Also joining along with Ms. Sinha is Mitali Nikore. She's the founder and economist at Nikore Associates. Thank you very much, Ms. Sinha and Ms. Nikore, for taking the time out and speaking to us here on ET. Now, let me come to you first, Ms. Nikore. We're not really questioning that India's demographic dividend might not be playing the part. Definitely, we have that huge advantage. But the IMF's recent ratings with respect to India's national account statistics, they paint a not so rosy picture. So my question to you is, how concerning is that concern or that grading that IMF has presented with respect to the Indian economy? And how do you reconcile these two aspects?
No, so thank you so much, very much for having me on the show today. I think the first point that we have to recognize is that India has been the fastest growing economy globally and the fastest growing emerging economy in the last decade. And it's not as though, this data is very new or is presenting itself, suddenly or in a manner that none of us expected. I mean, for the last decade, being part of these systems, being part of international organizations, we have been assessing the government of India's data and relying on the government of India's data in many ways as the most accurate form of that. When we look at the quality of the National Sample Survey Organization, when we look at the quality of the insights that are coming from the NSSO, there is absolutely no question about the sanctity of the work that is being done by the wonderful economists and statisticians in the government of India. So really the question becomes, why is it that the IMF is raising these issues? What is the sort of transparency it's expecting? I think it's very important for there to be dialogue because, of course, India wants to be recognized for the quality of its statistics at a global stage. But at the same time, I personally don't find any sort of discrepancies in the data. And India has demonstrated a superlative qualitative performance. And the data is also born with, when you look at the industry. The industry themselves is telling us how fast demand is growing, how fast the manufacturing is processing. And when there is a slowdown, we see that also. So therefore, I'm a little bit confused about this rating at this point.
All right, and that is a point well taken, but we are not only discussing about the dialogue, but also the pure data. And the pure data says that nominal GDP is not growing the way it should have been or it was anticipated. And therefore, Rajni Sinha, I want to come to you. Do you think that the growth of nominal GDP, not the real one, is concerning?
So, firstly, it's a very nuanced picture that we have. If I look at the real GDP growth, it was expected to be strong. We were expecting, most people were expecting in the range of 7 to 7.5%. But yes, the quantum jump that we have seen, 8.2%, that has turned out much higher than expected. There are various factors, so I'll come to that later. But now coming to your question on whether, the nominal GDP growth being low at around 8.7% or so, if that's concerning, yes, that is concerning because that's basically reflective of what's happening to the inflation in the economy. And, given that we are aware that CPI inflation is at a low of 0.25%, WPI inflation is in the negative zone, we are seeing that overall inflation situation is very, very benign in the country. But that also means that the pricing power is low, and that would get reflected in, probably in corporate revenues also. And the bigger players, they will be able to pass on, they will be able to increase prices, but maybe it would be a challenge for smaller players. So that's one way in which, this low pricing power will impact. Secondly, if the nominal GDP growth is so low, it will also have an impact on government's finances. It will impact the government's revenue collection, which anyways, if you look at the year so far, the direct tax as well as indirect tax revenue collections have been low, and the growth has been much lower than what had been budgeted for the year. So there is a struggle there. Fortunately for the economy, we have got good non-tax revenue in the form of dividend transfer by RBI, and that will help take care of the government finances. But yes, if the nominal GDP growth is very low, it will have an impact on government's revenue collection, and it will have an impact on the fiscal deficit ratio, which is taken as a ratio of GDP. So if the nominal is very low, it would kind of, push
Right.
up the ratio. So that way, it will impact the economy.
Absolutely. And that, Ms. Sinha, that needs to be looked at. I'll come to you, Mitali, just a bit, but let me take your point across to Ms. Sinha. Ms. Sinha, Mitali was essentially stating that this is not something that we did not really expect, and she doesn't quite agree with what the IMF is stating and the ranking that it is given to the Indian economy in terms of how it collects data. But the IMF is merely mentioning that India lacks seasonally adjusted data and that metrics have not been upgraded. Now, this is something that Sanjeev Sanyal has also mentioned. He says that he agrees that these should be updated, and he has made that point before. What is your take on this entire debate about India having to upgrade its metrics with respect to whether it's the calculation of the GDP or inflation or consumption overall?
Factors that IMF has highlighted, we are aware of those factors. So broadly, I'll tell you the issues that they have highlighted, and they are not new issues. We are aware of it, and in fact, MOSPI is working on those issues, and the revised base and the methodology that we are going to have next year will take care of some of these issues. So one issue is that we have a very old base. So we are GDP, we are still working with 2011-12 base. And in the last decade or so, a lot has changed. A lot of new sectors have emerged. The importance of those sectors have increased. Some of the sectors, probably which were important in a decade back are not very significant now. So in that sense, there is a need to revise our base year, which is being done. And next year, we are going to, government is releasing, MOSPI is releasing the GDP data with revised base of 2022-23. One of the other issues, second issue, broadly, if I look at the issues, is about coverage. So what happens is that in India, we have a large share of unorganized sector. So very often one question that is raised about, our GDP data is whether it is adequately capturing what's happening in the unorganized sector. So one view is that currently the methodology that is being used is not able to adequately capture that. And sometimes that's the reason why the GDP number doesn't feel very aligned with the ground reality. So in that sense also that, the revised methodology that we are going to have next year, MOSPI has given details of, how they are going about it. And they are going to look at more data sets that have become available in the last decade. They are also going to incorporate more surveys compared to what was being done in the current methodology. So, in that sense, our methodology should become more robust going forward. Another issue, third issue that I would like to highlight is that in India, for our GDP, we use uh, broadly single deflation. Like it's kind of mixed methodology that we use. Like for agriculture, we use deflation, whereas for manufacturing, we're using single deflation. So that's also kind of considered as a weakness of the
Right.
methodology.
Right.
So
Point.
that also they're looking at changing.
Right, point well taken. But I want to ask now one simple question. We have seen in Q1, everybody missed estimates. The best of the estimates was 6.5% to 7%. It came in at 7.8%. In Q2, similarly, the best of the estimates were up to 7.5%, if I remember correctly. It came much more than that. Why is everybody missing those estimates? Why is nobody able to guess the real GDP growth which is happening? And it is not just economists, whether RBI or even rating agencies are not able to guess what is happening on ground. What is the reason, according to you, Mitali?
So thanks a lot for bringing me back into the conversation. I would say that, at the end of the day, there are certain, forecast errors which are quite normal. Within a range of zero point 0.5 to 0.25 is a usual forecast error, which we always expect. At this time, when we looked at the 7.4 range or you looked at the 7.8 range, at that time also there was a base effect kind of a forecast error that was taking place. Now, for this quarter, one of the major reasons that a lot of forecasters actually made higher errors was because they were expecting a much stronger impact of the US tariffs to hit the Indian economy. When the US tariffs of 50% were imposed, that was an occurrence that nobody could predict. We could not actually be sure that what would be the impact. So everyone went ahead and said this will have a much larger impact than it actually did. And also, we found on the ground, we've been doing consultations with industry on the ground at Nikore Associates, and we found that several exporters have worked very hard in the last 2 quarters to diversify their exports and find new markets for their exports. And one of the major reasons we all expected, this performance would not come through is because of the dampening impact of global value chains, which to that extent didn't play out thanks to thanks to the resilience of our exporters. So I do feel that somewhere in this particular quarter that forecast error was a little bit larger than what was impacted and what was expected, only because of the fact that there were a lot of global elements at play.
Right, Mitali, lots of global elements at play. But let me take this point across in terms of, when you say that there's been an impact of, the United States elevated tariffs on India. But Rajni, these GDP numbers that ended for the month that ended in September, will it be correct to assume that the US tariffs did not really have an impact? Because when we speak to exporters, they that even though the government may have undertaken diversification drives, exporters might have tried to diversify some of the exporting commodities like shrimps to newer markets, like, for instance, the European Union. However, the Commerce Secretary, a couple of weeks back, he himself stated that the actual month which should be calculated to assess the impact of US tariffs is October. It's not really September. So is this GDP print that we are learning, is it is it going well with what the Commerce Secretary stated? And given the fact that, many say that there's not been any impact of US tariffs, will that be correct to assume?
So the US tariff, the additional tariff became effective from end August. So it will get reflected in the September data. So if you look at the second quarter data, it's only 1 month that impact will be there. And in fact, what has happened was that in the months prior to that becoming effective, which is in September, before that, we saw very, very strong export growth because, there was front loading that was happening. because the exporters as well as the US importers or global importers, they knew that this is going to come. So, and hence they were kind of, building up on stock. So there was front loading of exports that happened, which also is a reason why the GDP growth data that we have for the second quarter is very high. Now, coming specifically to what has happened post the tariff became effective from September, if we look at the September data, initially when the preliminary exports data came, there was a contraction. But when it was revised, then we again saw a YOY growth of 12% or so. The October data that came, again, the preliminary data is showing a contraction, but we don't know whether the final data will again show an improvement. So what has happened is that if you look at the breakup of exports, while in the 2 months data that we have, while exports to US have definitely got impacted, they have contracted, but at the same time, like Mitali highlighted, the exporters have managed to diversify their exports or reroute their exports to US through other markets, because of which overall exports so far has not got very severely
Right,
impacted.
right. Rajni, one final point before we let you go, because we are completely out of time in this discussion. Now, RBI is meeting this week. On 5th of December, we'll come to know whether or not Reserve Bank of India is going for rate cut. What is your expectation? How will this data come into play?
We are of the view it's going to be a very difficult task because the growth number is so high, inflation is so low, but we still feel that there is a possibility of rate cut because we are expecting some bit of moderation in growth in the second half of the year. So RBI may use this window of opportunity to cut like a shallow rate cut of around 25 basis point or so, because the global uncertainty is going to continue going forward. So they may use this opportunity to cut rate by 25 basis point, given that inflation is so low.
All right, Rajni and of course Mitali, thank you very much for taking the time out and giving us an understanding of India's macroeconomic credentials, the GDP data that came up, and of course it'll be interesting to watch out for what the trajectory the RBI is going to take on the rate cut scenario, on the policy making scenario as far as India's rate cut trajectory is concerned. But for the moment, thank you very much for taking the time out.